PMI versus MIP. Hey everyone, what is happening? It is Jeff Trevarthen, Jeff the Mortgage Pro. Thanks so much for watching my show. I appreciate it so much. If you find this content that I'm putting out here valuable, if you do me a huge favor and click the like button down below, that helps get this video out to other people. And then if you would like to continue to receive these videos about anything and everything mortgage and all the education information that I'm hoping that I'm providing to you, please go ahead and subscribe to my channel. I'd love to have you get an alert whenever my videos come out. It's usually every Tuesday and Thursday as of right now. So thanks again. But let's talk today about our PMI versus MIP. So what does PMI stand for? It stands for Private Mortgage Insurance, and MIP stands for Mortgage Insurance Premium. And it's important to know the difference between the two. So PMI is associated with conventional loans and sometimes jumbo loans. And those things have to do with mortgage insurance, obviously, on those types of loans. And MIP, Mortgage Insurance Premium, has to do with FHA loans. So there's a difference just inherently. You'll often hear that people confuse the terms MIP, Mortgage Insurance Premium, or private mortgage insurance interchangeably, but that's the difference between the two. So let's jump into private mortgage insurance first. Just know that this is credit dependent, meaning that the lower your credit is and the less money that you put down, the higher your private mortgage insurance is going to be. Okay. So let's say there's different tiers too. So anything between 3 and 5% down for conventional loans is going to have the highest of those premiums. Anywhere from 5 to 10 is a little bit lower. 10 to 15 is a little bit lower, and then 15 to 20% down is going to be the lowest of those tiers for private mortgage insurance. And then it's also, again, like I just mentioned, down payment dependent. So if you are going from 3 to 5% down, that's going to be the highest. If you're going to have 5 to 10% down, it's going to be a little bit lower. 10 to 15, a little bit lower, and then 15 to 20 is the lowest. So good credit and more money down towards 20% is going to give you the lowest amount of private mortgage insurance that you'll have to pay going forward. So you can eliminate private mortgage insurance once you have 20% equity. And real quickly, how you do that is you contact the servicer. That's the person that you have on your mortgage statement, whatever bank that is. There should be a phone number on there. Call them, ask them what to do. They'll tell you to get an appraisal. You go out and get an appraisal, bring it back. Once you have 20% equity, by law, they have to eliminate the private mortgage insurance. So you could do it that way. Or the other way to do it is just to continue to make payments on it until you reach a point of 78% loan to value ratio, or a 22% equity in the property. Once you have 22% in the property, you'll be able to eliminate the mortgage insurance without having to do anything, because it's assumed that you'll have enough equity at that point to go ahead and move forward. Okay. So the other type of mortgage insurance here is the mortgage insurance premium, and this is associated with FHA loans. This is not credit dependent. If you have an FHA loan, you are going to get a mortgage insurance premium, and it's going to be X amount of dollars depending on how much you have for the down payment. So if you have more than 10% down, then you will have a certain amount of mortgage insurance premium that you have to pay. If you have less than 10% down, then you're going to have a certain amount of mortgage insurance premium to pay. And the reason why I'm not giving you specific numbers is that it has changed over the last couple months. Most people that probably have loans, are more than 3 months old in terms of the mortgage insurance premium. So those numbers vary. And at some point, I'll get you those numbers here so you have an idea of what they look like. But they are associated with FHA loans, like I mentioned. Once you have more than 10% down, you can actually eliminate the mortgage insurance premium by making a payment on it for 11 years. Okay, so that's one way to get rid of it. If you have less than 10% down and you're doing an FHA loan, there's no way to get rid of mortgage insurance. It's for the life of that loan. The only way that you can get rid of mortgage insurance when you have a mortgage insurance premium and an FHA loan is to actually refinance out of it. Now, there's a couple ways that you want to look at this. And if you have less than 20% equity, you might do a comparison with your lender. Hopefully that's me. And we'll run an analysis to determine, do you have enough equity in your property Number one, to eliminate it altogether. So if you have more than 20% equity, we can eliminate the mortgage insurance altogether, most likely. But if you have good credit and for the most part, you got an FHA loan because you just had a low down payment, but the property has since appreciated, maybe you have 10 or 15% equity in that property, it's worth taking a look to see if just the private mortgage insurance would be less than the mortgage insurance premium, because oftentimes there's a difference and there's a savings that's going to be available for you just switching over from mortgage insurance premium to private mortgage insurance. So have a reputable lender run those numbers for you so that you know. Okay, so that's the difference between PMI and MIP. I would love to hear if you have that. Are you reaching out to your lender right now to try to eliminate that? There seems like, in 2023 here, there's lots of equity in properties. Even though rates are higher, there's still substantial savings to be had out there and available if you can eliminate mortgage insurance altogether, or if you have to refinance out of it into a new loan, into hopefully lower monthly mortgage payment. Just getting rid of that mortgage insurance is definitely going to help you going forward. Okay. If you have any questions at all, please feel free to reach out to me. And thanks so much for watching, and look forward to chatting with you on the next show. Have a good one. Bye.